Hello and welcome to another round of exciting loan originator training. I am Andy Johnson, your compliance officer, and over the course of this training, we will discuss some of the requirements placed upon loan originators, some of the more applicable regulations to be aware of, as well as some key parts of the lending process as a whole in order to point out some traditional stumbling blocks when it comes to originating and booking a compliant loan. First, we'll start with some of the basic federal requirements placed on loan originators that we need to know about. As consumer loan originators, there are two key requirements that you need to be aware of which govern our actions: the SAFE Act and Regulation Z. The SAFE Act is part of a larger Housing and Economic Recovery Act of 2008. This came in response to the subprime mortgage crisis that unfolded around that time and devastated both consumers and the real estate industry financially. One of the main provisions of the SAFE Act is to require all employees who act as mortgage loan originator to sign up on a nationwide registry. And when I say mortgage, read that as more of real estate secured loan. It could mean home equity loan, HELOC, construction loan, or anything else secured by real property. This NMLS registry will designate each lender a unique identifying number, and it will require annual reattestation that everything is still correct. There are also a strict number of timelines for things like changes to employment, updating personal information such as name or address. The SAFE Act also requires us to disclose our unique identifier in specific situations. These situations include things like when we're requested to do so by the applicant, anytime we act as a loan originator, through any written communication with an applicant, and this can include on the loan documents and especially through email. If you do not have your NMLS number in your email signature, you need to correct that immediately upon completion of this training. The systems should automatically be placing your NMLS number on the required loan documents, but you may want to double check before sending them out to be signed, as your number populating correctly and in the correct location is ultimately your responsibility. Along with the SAFE Act, loan originators are required to comply with Regulation Z of the Truth in Lending Act, and the requirements spelled out within that large, robust regulation. Reg Z requires that loan originators must receive periodic training covering all requirements which apply to them and their activities. So if you want to know why you have to sit through this amazing training today, this is why. Blame your congressman, not your compliance officer. Reg Z also touches on what types of items need to be disclosed to the applicants on these loans that you're originating. As with any loan, you always start with the application. There are a number of specific items which must be present on the application in order to be valid. These specific pieces of information you must collect for Uncle Sam so they can ensure that we treat every applicant as equal. So what types of information need to be disclosed? Well, thanks to the Dodd-Frank Act of 2008, quite a bit actually. These are just some things that will need to be disclosed and disclosed within a certain time frame from when we receive an application. For HELOCs, there are also additional disclosures as well. The loan estimate is one of these disclosures. This is probably the only document your applicant will waste any time looking at, so be sure that it is accurate every time we send it out. The loan estimate will disclose specific details about rate and terms of the loan that the applicant is applying for. There are very strict timing requirements and very, very specific requirements on what this form even looks like and how it must be disclosed. The exception for this document is that HELOCs and loans on dwellings not affixed to the ground, such as mobile homes, won't be required to be subjected to this. Yet. That may change in the future, but for now, this would only apply to home equity loans, construction loans, and the mortgage side of things. So when does the regulation tell us that we need to send this document out? According to Reg Z, you need 6 points of information in order to officially have a completed application. In the rare instance that someone applies and you don't have all this information, you will need to reach out as soon as possible to obtain it. Even though our loan estimate and disclosure clock doesn't officially start, we cannot sit on partially completed applications very long. Along with the loan estimate, we must have the applicant complete the intent to proceed form. Congress, in all their wisdom, decided it wasn't enough to have the applicant submit a 7-page application with everything short of their blood type to us to begin this process. We must now ask, are you sure you want this loan before we even begin? Once the intent to proceed has been returned to us, we can begin charging applicable fees if necessary, such as appraisal fees, and work towards closing the loan. Reg Z also has some specific directions surrounding appraisals or valuations completed on these types of loans. In the regulation, it states that we are required to provide the applicant with a copy of any valuation model we use to judge how much their property is worth throughout the course of the loan. That could mean a copy of the actual appraisal report, or if we use electronic valuation models, to provide them with that number. It also provides specific timing requirements on when we need to get that to the applicant and how far ahead of closing it needs to be sent out. However, the member can opt to waive that right by signing a waiver form and simply receive that report at closing. If they don't sign the waiver, however, we are required to send this out immediately upon receipt of the report from the appraiser, or at least 3 business days before the close of the loan, whichever one is earlier. In the instance your subject property is located in a flood zone, yippee! We are now required to show proof of flood insurance coverage on the property before we close the loan. Flood insurance is different than regular hazard homeowners insurance, in that there are very specific criteria which must be met for the insurance to be acceptable to investors. First, the flood insurance coverage should be active and enforced before the loan is closed. The credit union will require this insurance for the duration of the loan. The coverage amount must also be at least equal to the lesser of the 2 options, either at least matching the balance of what the loan will be, or up to $250,000 maximum, which is the maximum flood coverage under the National Flood Insurance Act. If the applicant refuses to provide flood insurance for a property located in a flood zone, we can buy it for them at a higher cost and force place the insurance. However, with everything else in this regulation, there are strict timing requirements and waiting periods, so do not expect a flood loan to close quickly. If we force place insurance and the borrower decides to pay for their own down the road, they are entitled to a prorated refund of premiums on the force placed policy if the timing overlaps. Not every application will be approved. That's just the way of the world. Whether due to poor credit, too much debt, or another objective criteria, sometimes we need to notify applicants that we are taking adverse action, or action they won't want on their application. Adverse action notices are sent out if we refuse to grant new credit, aka deny an application, if there are unfavorable changes to a borrower in the terms of an existing account, aka modifying the terms in our favor due to increased risk on the loan, or if they request an increase on a lending limit on an existing account, and we will deny that increase, such as raising a HELOC line. Within 30 days of receiving a completed application, of failing to receive a completed application when sitting on a partial app, or of issuing a counter offer which was not accepted, an adverse action letter must be mailed to the applicant for this completed loan. Adverse action notices must be sent out on withdrawn applications as well. A withdrawn application can only be considered so when an applicant specifically asks us to withdraw it. Otherwise, is considered an approved but not accepted application. An item of note is that Gary will send out weekly lists in Lucas for applicants who have sat longer than 30 days in an inactive status. These must be cleared immediately through either finishing the loan and closing it or through the adverse action process. Please do not sit on these when he sends them out. Just as the application process has its own set of rules and requirements and disclosures, guess what? So does the closing side. We're required to send out a closing disclosure, which is similar to the loan estimate, within a certain amount of time before closing so the applicant can review the numbers one last time. The closing disclosure will have more exact figures and a final loan number spelled out in detail for the applicant, as they will also be required to be presented with the right to cancel notice on certain loan types as well. The closing disclosure, except on HELOCs and mobile dwellings, will be required to be sent out at least 3 days prior to closing. If something delays your ability to send out the closing disclosure, either through internal circumstances or changes on the loan terms, you will need to change the closing date to accommodate for this timing requirement. So how do we know when the 3-day clock starts? You must account for different delivery methods before you begin your countdown to closing. Make sure you take these into account when setting your closing dates. Physical delivery, delivery by mail, and electronic delivery all have different timing requirements. If, on the off chance you need to redisclose your closing disclosure, You must wait an additional 3 business days before you can close. This would be required if the APR jumped out of tolerance due to fees changing too much, loan amounts changing due to drastically different appraised values, if there's a product change, or if we decide halfway through to ever add a prepayment penalty. The notice of the right to cancel is another specific disclosure we will need to provide in certain circumstances. Just like everything else, we will need to send this document out within specific times. This notice must also be received by us by a specific time frame. Borrowers do not get unlimited amounts of time to change their mind on the loan. They must return the written notice to us not later than midnight by the 3rd business day that the last action on the loan was taken. This is usually the closing date, but not always. Fair lending laws also govern how we treat each applicant on consumer-oriented loans. This is to ensure we are not treating applicants differently or denying anyone the right to apply for credit based on discriminatory practices or decisions. One thing to note with fair lending violations is that regulations do not specify proof. That means that the credit union and you individually as lenders can be found guilty, even through implied discrimination. The Fair Lending Act is comprised of 2 major laws, the Equal Credit Opportunity Act, or ECOA, and the Fair Housing Act, FHA. The ECOA actually applies to all loans and prohibits discrimination during any part of the lending process, including when the loan is closed and when installments are being paid during servicing of the loan. As a lender, we cannot discriminate against anyone based on the above referenced categories. The Fair Housing Act has similar criteria in that law for prohibited bases, and there is some overlap in each regulation. As a lender under ECOA, we cannot ever ask if an applicant is receiving alimony, child support, or separate maintenance. Likewise, we cannot count that income if they claim it unless we can get proper documentation that they are receiving it. Rather than asking, "Do you receive this type of income?" we should ask open-ended questions to avoid fair lending violations, such as, "Do you have any other income that you want to use to qualify?" There are 3 types of discrimination we need to guard against when discussing an application and borrowers. Overt discrimination is blatant, and it should never be tolerated. An example is offering different terms, rates, or limits on loans based on one of the prohibited classes. The second type of discrimination is disparate treatment. This is when it is implied that 2 different borrowers in similar circumstances are treated differently. There are some examples listed there above, but it could be as simple as offering one borrower a second chance at an approval, a different loan program or product, or different terms than another borrower who has a similar credit score, income, or other criteria, simply because they happen to be a male versus a female, a white versus Hispanic, married versus unmarried, etc. Disparate impact is similar to disparate treatment, except this is when a policy or procedure is applied to everyone, but it can negatively impact a protected class, even by accident. Oftentimes, financial institutions will fall into this, trying to avoid accidental discrimination through disparate treatment. An example would be if Community Choice decided not to make any loans under $60,000 because it wasn't profitable or because we didn't want the higher risk of foreclosure with those types of homes. And so by having a policy decision, we effectively prohibit a large population of either minority or low-income applicants because it's all the home they can afford. So because of their circumstances, they're not able to apply for a loan with us. That would be a fair lending violation. The Fair Housing Act is on the other side of fair lending, and while there is some overlap with protected basis with ECOA, they can also include things like familial status, such as being married or divorced or in a civil partnership, and handicaps, which could also be mental or physical. Under FHA, the credit union cannot treat anyone differently, use different standards to determine approval, to service a loan differently, to look at collateral differently, or to change terms based on a prohibited basis. The Fair Housing Act also specifically prohibits activities such as racial steering, which is pushing people to a specific or safer product for the credit union based on their race, redlining, which is not lending to anyone from a specific area based on where they live, such as we don't lend to people in Dallas County. We also cannot have single race advertising. We can't discourage applications from anyone. We cannot place additional burdensome qualifications on any applicant. We cannot make some people subscribe to stricter terms and conditions than others, and we cannot discriminate specifically against women. Another consumer protection regulation is the Service Members Civil Relief Act, or SCRA. This is to assist deployed service members to obtain relief while they are away serving our country. Some of the perks for these borrowers are an interest rate cap, which is set at 6%, foreclosure protection while they're on active duty, and a determination of who is considered a covered borrower. The interest rate on debt already held at this time that the borrower goes on active duty must be reduced to 6%. The regulation has not been updated to accommodate for lower interest rate in recent years, so you probably won't see a lot of requests, as a lot of debts are already below 6%, but it's still their right to request SCRA protections. For any mortgage-related debt, including home equity debt, the 6% cap would remain in place for 12 months after the borrower comes off active duty. Similar protections are in place under SCRA for foreclosures. We cannot foreclose during their active duty period and for at least 12 months after the borrower returns from active duty. In order to determine if a borrower who requests protection is active duty, we can ask for a copy of their orders, or we can register for the Department of Defense database. It has a SCRA website and will provide us with active duty dates for that borrower. If you have any questions on today's training or want to know more about anything we've discussed, please feel free to reach out to me and I'm happy to help any way I can. Please do not forget to register for the quiz upon completion of today's training. The employee with the highest overall score at the end of testing will receive a cool prize from me and the title of Compliance Officer's Ultimate Super Awesome Master Lending Person and All-Around World Champion. Thank you.